Yeah, and the only other real question I have, I don't want to take up everybody's time, and I've got a hard stop here in a bit, is the hardest thing I'm trying to get, and I'm not super familiar, though I know enough about this business to be dangerous, is the liquidation, right? And does how much of any kind of control does the investor have to liquidate, either to sell off, I guess, his shares at some kind of discount, or if he doesn't want to wait, in the models, it looks like it's kind of a 10-year model or a 9-year model. And that's kind of long for me, at this point in my life. And I'm sure a lot of the guys that I've done deals with, that's just a long hold, right? And I know it's probably the nature of the business. So I don't need per se an answer right now, but just if there's a mechanism in which individuals can kind of control somewhat of their own liquidation fate, if you will, that would be helpful. And I don't know if you guys even thought through that, but it's just a long haul for a lot of the appetite of at least the investors that I deal with.
Let me answer several of the questions in there, because I think we can give you a good answer right now. Okay. First, the 10-year projection model is we really wanted to see what the compounded free cash flow being reinvested back in the business would look like over a 10-year horizon. Right. The model we think is actually quite conservative in the cost and the uptake. So those are the two biggest drivers. Cost of the equipment, cost of drilling is one set. Those are your drilling costs, your setup costs. And then the second biggest assumption is the uptake rate. You drive a piece of fiber optic in the easeway in front of someone's house. How many of those houses actually connect? Those are your two biggest drivers. If we have any kind of mechanism, so that's really the reason why we needed to have a 10-year model to sort of understand the compounding. Right. If we have a debt instrument that has to be subordinated, that would need to be subordinated to any bank debt. And if it's less than 3 years, less than 1 year, we have to actually treat it as a current liability. At 3 years, it's still in the audited financials will be listed as a liability of the business. And that will cause the banks some concern, and even to when it's subordinated, because that's an impending refinancing that's required by the company. So a debt structure shorter than 3 years really creates substantial financial limitations to the business in terms of what it could borrow for growth because of the impending debt retirement. So I think a debt structure really doesn't work. I think an equity structure, but an equity structure that gets you out to a certain EBITDA threshold is actually the better mechanism. An equity structure that has a put, that is the ability for an individual shareholder to say, I want my money for these units. That also becomes something that has to be footnoted. And depending on the nature of the put and the rights of the investor, that put can look like a debt repayment. Right. And that becomes an issue in the eyes of the senior lenders.
Right. And is there already a predetermined prep on that?
I think the answer is we're suggesting 6%. And that's really a time neutral idea. Right. And so the idea is that it gets you away from creates a time neutral position. So that really what you're saying is I'm looking at the value of the business in a horizon when there is an adequate amount of EBITDA to do a recap. Okay. And I think the amazing thing about the density of this market is we think it happens actually fairly quickly. Right. Yeah, it's like 10 years. And I would say that's where we think somewhere between, we're conservatively saying in the 2 to 3 year horizon.
Right. And is the valuation on EBITDA what around? I think I took a quick look. It was around 10, a 10 multiple.
Well, the valuation multiples are the valuation metrics are generally against actually connections. So,
yeah, that was my question.
Yeah. So if 10,500 per connection is for a business that's at 3 or 4 or 5 times the scale of this business in 3 years, discount that back to say 5 or 6 grand per connection. At 10,000 connections at 5 grand, you got a $50 million business 18 months from now.
If not more.
Yeah, if you look at, you
I
know,
mean, I'm just using simple cowboy math.
Or worst
And,
case.
and that serves where a private equity firm, traditional 10-year private equity structures suddenly make sense. And that's where we take out the Series B investors today in a three-year horizon, is that they get refinanced out, or literally on a case-by-case basis, they get the option to either stay or be cashed out. It'll be really binary. You won't get to take some of your money off and keep some in. The institutional investor will say, if you're out, you're out altogether.
Mhm.
But at that point, and I realize your point about your horizon, your personal investment horizon, the question will be for you at that point is, you have no more investment. They're putting all the rest of the capital in and ensuring the growth of the business. They have more wealth in the deal than this group of investors will have. The challenge that you'll face is you won't have any ability to drive any decisions on an exit, because that private equity firm will control the exit strategy.
Yeah.
And they have a 10-year horizon.